Are you frustrated by the unpredictable swings of the stock market? Well, get ready to change your approach with a simple strategy that has been created by none other than Peter Lynch. As the former head of Fidelity Magellan Fund, he achieved great success by focusing on what he knew best, the basics of companies. So, if you're ready to start making smart investment choices, stick around, because by the end of this video, you'll have the tools you'll need to outperform 90% of other investors. Of course, like and subscribe if you love money. Stay in your lane. As per Peter, people often don't realize their own strengths and miss out on using them. This smart observation gets to the core of his investment philosophy. He strongly believes that everyone has unique insights and expertise that can give them an edge in the stock market. Instead of following trends or going with the crowd, Lynch encourages investors to focus on what they know and understand. His philosophy is quite simple. Invest in what you're familiar with, whether it's a product or service you use every day, or an industry you know well because of your job. He wants investors to stick to their area of expertise. For example, if you work in the tech industry and know a lot about emerging trends and innovations, you might be better at assessing the growth prospects of tech companies compared to the average investor. Similarly, if you regularly use a certain product or service, you probably have valuable insights into its popularity, quality, and how it stacks up against its competitors. But why is it so important to invest in what you know? The answer lies in Lynch's belief in the power of familiarity and expertise. By investing in companies and industries you understand, you can more accurately evaluate their long-term potential and chances of success. This reduces the risk of making impulsive or uninformed investment decisions based on short-lived trends or hype. Sticking to familiar industries can also lower risk and increase the likelihood of investment success. When you have a deep understanding of a company's operations, competitive advantages, and what drives its performance, you're better equipped to navigate market fluctuations and make strategic investment choices. In short, Lynch's foremost advice is about leveraging your natural advantages as an investor. By focusing on what you know best and staying within your circle of competence, you can increase your chances of success and achieve better investment results in the long term. And if you want to know about the secret behind long-term success of a firm, the next strategy could help you in determining this fact: the 100% correlation. One of the cornerstones of Peter Lynch's investment strategy is his emphasis on direct correlation between a company's earning and its stock performance. Lynch firmly believes that over the long term, a company's stock price will ultimately reflect its underlying earnings growth. To understand this point, let's consider the example of McDonald's. Suppose you're thinking about investing in McDonald's stock. Here, according to Lynch, the key factor to consider is not external factors like changes in the economy or fluctuation in interest rates, but rather the company's fundamental performance. The focus on company fundamentals is crucial for successful investing because it helps investors cut through the noise of short-term market fluctuations and focus on the factors that truly drive long-term value creation. By analyzing a company's earning growth potential, cash flow generation, and competitive positioning within this industry, you can make more informed investment decisions that are grounded in sound financial principles. Unfortunately, many investors fall prey to common misconceptions about the factors that impact stock prices. They believe that external factors like changes in interest rates, geopolitical events, or macroeconomic trends have a significant impact on a company's stock performance. While these factors can certainly influence short-term market movements, Lynch argued that over the long term, it's a company's earnings growth that determines its stock price trajectory. For example, let's say that there's a sudden increase in interest rates that cause stock prices to plummet across the board. While some investors may panic and sell their shares, Lynch would advise taking a step back and focusing on the fundamentals of individual companies. If a company like McDonald's continues to generate strong earnings growth despite the macroeconomic headwinds, its stock price may eventually recover and continue to grow over time. This strategy is grounded in the belief that successful investing is all about focusing on what you can control, which are fundamentals of individual companies. But what if you know about the future of a company, whether it will sail or sink? Well, stay tuned, because what we're covering next is something that can give you great returns with your investments. Buy what you know. Now that we've looked into Lynch's ideas about understanding company earnings and stock performance, let's focus on creating a portfolio based on his principles. This thing revolves around thoroughly understanding a company before investing in it. Peter Lynch advises investors to buy what you know. This means researching and analyzing companies within your area of expertise, industries and businesses that you know well, similar to our first point. But what does it really mean to understand a company? According to Lynch, it's more than just looking at financial statements or stock charts. It's about being able to explain a company's business model in simple terms, understanding how it makes money, what makes it unique, and what drives its success. Lynch often used his wife's experience with Dunkin' Donuts as an example. When she praised the quality of their products, he saw it as a sign of a well-managed company with great growth potential. By understanding the business firsthand, he made informed investment decisions that paid off. But understanding a company goes beyond familiarity with its products or services. It requires thorough research and analysis of its growth prospects, competition, management team, and financial health. This may involve studying reports, listening to earnings calls, and staying updated on industry news. Remember, successful investing is about long-term investments in solid businesses, not timing the market or seeking short-term gains. Let the power of compounding work in your favor. And when considering an investment opportunity, ask yourself, do I truly understand this company? Can I explain its business model simply? And have I done my homework to assess its long-term prospects? If you do these things, you'll be well on your way to building a successful investment portfolio that outperforms most investors. And if you're still not able to generate your desired profits, then you must seek out the next important advice from Lynch: the real deal. One of the most compelling aspects of Lynch's strategy is its simplicity and accessibility to everyday investors. According to him, if you don't understand a company, you shouldn't own it. This straightforward advice has resonated with countless investors over the years and has led to many success stories. In the decades of the 80s, there were over 8,000 investment clubs across the United States, many of which followed Lynch's approach. And surprisingly, 62 of these clubs managed to beat the market, outperforming even seasoned professionals. But it's not just investment clubs that have found success with Lynch's strategy. In a fascinating experiment, a 7th grade class at St. Agnes School in Arlington, Massachusetts applied Lynch's principles to the stock market with amazing results. The students were tasked with studying companies, analyzing their balance sheets, and picking stocks based on their understanding of the businesses. Later, they came up with a portfolio that outperformed the market by a significant margin, with returns of 69% over 2 years, compared to just 20% for the broader market. But Lynch's strategy isn't just for amateurs. It has consistently outperformed even seasoned professionals. In the 80s, when Lynch was at the helm of Fidelity Magellan Fund, his track record was nothing short of remarkable. Despite the ups and downs of the market, he consistently delivered impressive returns for his investors, earning him the title of America's #1 money manager. What makes Lynch different from other investors is his ability to cut through the noise and focus on the basics of investing. While many investors get caught up in market trends and economic forecasts, he stays focused on company earnings and business fundamentals. But if you're someone who gets caught up in the excitement of chasing after a popular stock, then stay tuned, as the mystery of achieving long-term success in the evolving financial world is about to be uncovered. Applying Lynch's strategy in today's market. Despite technology's advancements and complex financial markets, Lynch's core principles are still relevant. His approach is all about keeping it simple and sticking to 3 main principles: invest in what you know, focus on the basics of the company, and think long-term. In today's fast-paced world, where information is constantly flowing and market trends change quickly, focusing on fundamentals is more important than ever before. For instance, many people struggle with market volatility and uncertainty, especially during economic downturns or geopolitical instability. Another challenge for investors is the temptation to chase the latest hot stock or follow the crowd. In today's market, where once again information is easily accessible and trading platforms are available to everyone, it's easy to get caught up in the excitement of buying and selling stocks. However, Lynch's effective strategies remind us to take a step back and focus on the long term. It's important to remember that investing is a marathon, not a sprint. While it's tempting to try and time the market or chase short-term gains, the most successful investors are patient and disciplined. As they all know, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. Whether you're a seasoned pro or just starting out, these principles can help you build a more successful and sustainable portfolio. And if you want to update your productivity game, then you should not miss the next video, 5-Part Framework to Every Business, The Personal MBA by Josh Kaufman, the animated book summary.